There's a lot of noise around embedded finance, from wallets to lending to insurance to investing. Why does embedded finance matter right now?
Embedded finance matters now because it's becoming invisible infrastructure. The global projections estimate the embedded finance market to swell over $7 trillion by 2030. People want convenience and personalization. AI is starting to power real-time credit, dynamic payment plans, user journeys that are context-aware.
What are the primary obstacles banks and fintechs face in adopting embedded finance?
The first one is compliance versus speed. The second is partner fragility. And the third hurdle, I would say, is legacy tech.
If my conversation with Trina today sparked any curiosity, share your thoughts with us and join us next time. Hi, I'm Michael Petrilli. I'm the director of NextGen Investing at ViewTrade. And in this podcast episode today, we're going to be talking about embedded finance. And our guest today is Trina Ray Chaudhary. She's an embedded finance expert with a background in consulting and founding fintech companies. So Trina here is going to help us through some of the complexities of trust, technology, and partnerships in this dynamic space. So Trina, it's great to have you on the podcast today. How are you doing?
Thanks for having me. I'm good, thank you. How are you, Michael?
I'm doing well. So there's a lot of noise around embedded finance, from wallets to lending to insurance to investing. From your perspective, why does embedded finance matter right now? And what's driving executives to take it seriously?
Embedded finance matters now because it's becoming invisible infrastructure. People don't want to stop what they're doing to log into their banking app. They expect payments, credit, or insurance to show up within the experience they're already having, whether that's in commerce, healthcare, enterprise software. The ask has shifted from use this finance tool to help me get the task done with no friction. And as a founder, I know this to be true. Customers drop off the moment that there's friction. An embedded experience keep them in the flow and lift conversion. Executives are taking notice because of market momentum. Global projections estimate the embedded finance market to swell over $7 trillion by 2030. And this comes down to three drivers. The first one is economics. Customer acquisition is expensive, loyalty is hard to keep, and margins are tight. And embedded finance opens new revenue streams without having to build everything yourself. Second is consumer expectations. As I mentioned before, people want convenience and personalization. The third is competition. Platforms outside of banking capturing relationships that used to belong to financial institutions. And we're already moving beyond basic integration. AI is starting to power real-time credit, dynamic payment plans, user journeys that are context-aware. And that's the shift from finance as a product to finance as the invisible thread that's running through everything. And this is reshaping traditional banking from a threat into a strategic opportunity.
So embedded finance makes it easier for the consumer, but we know it's very challenging as B2B platforms. So what are the primary obstacles banks and fintechs face in adopting embedded finance, and how can they mitigate them?
So three main hurdles stand out to me. The first one is compliance versus speed. Banks are cautious while fintechs move fast, and this regulatory rub often delays launch. And I have felt that firsthand in my business, very painfully, might I add. The second is partner fragility. In fintechs, you often rely on a single bank or a card issuer or some kind of single supplier relationship. And if that partner exits, your product can immediately collapse. And we've seen examples of this in Australia over the last 5 to 10 years with neobanks. And this was also a painful lesson that I learned in my startup about how fragile partnerships can be. And that's not a theoretical risk, that's existential for a startup. And the third hurdle, I would say, is legacy tech. Many banks are still on decades of old systems that don't play nice with APIs. The ways to mitigate these risks, firstly, build compliance in from day one, not as an add-on. We had a product deal get delayed by months because it needed to go through multiple risk and compliance flows that we didn't think of. And as founder, again, very painful lesson, but it taught me that banking compliance into design from the start is cheaper and it's faster than trying to retrofit it later. The second is treat partners like supply chain risks, diversify and align incentives so they view you as strategic and not transactional. And the third way to mitigate the risk is launch in phases. Piloting one use case allows iteration before full-scale rollouts.
Okay, yeah, amazing answer. And so you talked about how startups sometimes rely heavily on banking partner. What advice would you give startups relying heavily on a banking partner to help mitigate that kind of risk?
So, the biggest advice I can give is treat that partner like your most fragile supply chain. Always have a backup. Make sure the bank sees you or the incumbent sees you as a partner, not just another vendor. Negotiate upfront for scenarios that might end in a partner exiting or the tech falling over. It's much easier to secure these protections early rather than a middle of a crisis. And secondly, I learnt this later in my journey, is to keep building your own IP. So find ways to test your core value proposition, find your customer segments, potential revenue streams before you decide on a supplier to make this a reality, because that's not going to fall over if you just keep focusing on your core value proposition and your own intellectual property that can exist independent of the partners.
For core business models, right now in the embedded finance space, which one do you think is showing the strongest ROI today? And which one do you think will be growing the fastest in the future?
So I am biased because I started a payments business, but I would say payments and wallets get traction fastest, and that's because people use them daily. So adoption comes naturally. And where I saw the biggest lift was in contextual services. So things like rewards, credit, or micro insurance offered at the point of transaction. So when a customer is about to make a decision, instant credit or rewards, they will drive conversion and loyalty. And there's plenty of startups doing this very well at the moment in Asia Pacific. Insurance and investing are exciting, but they need scale to monetize. So the clearest return on investment, I say, is in payments.
Yeah, payments is a great answer. And I saw that it is definitely the fastest growing way that embedded finance is happening today. Personally, at ViewTrade, we like to focus a lot on embedded investing, and that's something that's a bit more behind. But I think the two can definitely work together, right? If we talk about payment and roundups into investing, that sort of combination between payments and investing, I think is something that could be a great ROI return and something not too many people are looking at right now.
Yeah, absolutely.
So, how can banks go beyond being commodity sponsorship towards true platform enablement?
The real opportunity is for banks to stop thinking of embedded finance as renting out a license and start thinking of themselves as platforms. That means offering APIs, compliance rails, even distribution channels that others can build on. The banks that shift from gatekeepers to enablers will create the most value. And I've seen both sides of this as a founder. You can tell very quickly if a bank just views you as another vendor or as a partner that they're willing to enable. And the difference is day and night. The ones that act as true enablers will create ecosystems.
So banks should be acting as ecosystems that fintechs can work with easily rather than maybe being a potential blocker for fintechs.
Definitely.
And so which tech innovation do you think that's happening right now? Obviously, a lot of talk about AI, the orchestration, tokenization. Which ones do you think are overhyped and which ones do you think are delivering right now?
Overhyped things like, AI will solve credit risk overnight or tokenizing everything without demand. Tokenization is promising, but it's held back by fragmentation. What is delivering right now is real-time payment rails, AI in fraud detection, and middleware that simplifies compliance. These things are saving money and creating value today.
And that's, I think, where banks and fintechs can be focusing right now today. There's obviously so much hype around AI, but where we're seeing real what the consumer's using right now, like you said, payments, payment rails, that stuff's not going away. It's very popular. And sometimes it feels like we're pushing something that the user isn't even asking for yet, right? Like tokenization of different types of products.
Yeah,
It's
totally
something
agree.
that maybe could happen in the future, but right now, definitely payments are where it's at. So, do you think in the market, are we moving towards a more consolidated full stack approach where providers full stack? Or do you think the better approach is to be more modular, pick the best of breed for each use case?
I think we're seeing both models emerge. Large institutions often lean toward full stack providers because it reduces complexity, it gives them one provider, whereas startups, and this is again where I'm biased, on the other hand, they go modular because they can choose the best in class tools, have flexibility on pricing, and most importantly, speed to market because that will make or break you in a fintech startup specifically. So, what would tip the balance is orchestration. So the ability to plug and play into providers seamlessly. So whoever it still could be a consolidated provider, but whoever makes it easier to swap modules will come out on top.
So, as a fintech B2B, definitely be focusing on being not exclusive to any one provider, right? Being able to swap in and out, being able to
Yeah.
work with a lot of different types of people, that will really give you an advantage over legacy, maybe where we're more locked in.
Exactly. And price and speed to market are the two most important factors here when you decide whether you go full stack provider or modular. So I would say, again, from a bias perspective,
Mhm.
they tip the balance.
So it sounds like banks can maybe take a little advice from fintechs that are working in a more modular space but what they really want
Absolutely.
is, they want one solution that they can go over with their compliance team, hit all the boxes. But a lot of times it's not really that feasible, right? So I think banks can try to be more flexible working with fintechs. And I see that slowly happening over the last few years. Banks wanting to grow more, wanting to bring more into to be more forward thinking. So in 3 years from now, what do you think is going to be something that's obvious that today is not in the consensus?
The trust and the value exchange with the customer, that is the greatest moat. And I could talk about customer value proposition all the live long day. Everyone will have a wallet or a credit line, but the winners will be those who manage risk transparently and build trust at scale. But most importantly, customers now expect a value exchange. Open banking, the emergence of open banking means they know that you're collecting their data and now they expect you to give them something in exchange for them allowing you to mine their data for your own purposes. So the opportunity to give them something meaningful back and everyone wins, everyone benefits from that data exchange, that's going to be a win-win-win. So that's what I see in 3 years is that customer will be the core focus rather than building monoline products that serve customers in different ways. It's how can we all win from this exchange?
So you're talking about using the customer data to enhance the customer experience. Could you give some more insight into that?
So data makes experiences sharper. It's not the only lever, but it is the most important lever. Focus on context, focus on timing. You can design value in a product when you solve obvious friction points. So faster checkout, instant eligibility, automatic application of rewards. For example, in embedding credit or rewards at the point of decision drives adoption without needing to profile the customer in detail. So customers value immediacy, but also relevance. And the value of having that data means you can personalize your offering. Yeah.
Okay. Yeah. So what if you have a case where the customer data isn't being used? How do you still create value and meaningful value experience for the customer?
I would say solving obvious friction points. So, like I mentioned, faster checkouts, rewards upon automatic application of rewards or points at the point of transaction, good design as well. I think UX is often underrated in things like fintech. You can build trust with a customer if you just observe how they use a product. And if you're not thinking of them in the actual design of the journey, then they're immediately going to put up their walls, right? And you really have to make sure the customer journey is on point. Otherwise, you lose trust very quickly. So even if you don't have extensive amounts of customer data, I think if you solve obvious friction points and make the journey for them as easy as possible from a design point of view, also very valuable.
And especially in this space, if we're talking about payments, it's something we all use as well. So I think a lot of times as businesses, we're focusing on the business aspect and we forget just we are also our own customer in this case. So,
Exactly. Yeah.
really building out that customer journey, looking at any friction points, reducing those, that's where fintech can win. So from the customer's perspective, as we've been talking about, what is the biggest advantage for embedded finance?
So we talked a lot about convenience and embedded finance being an invisible enabler. And this is what customers are expecting. They're expecting services to be contextual, to be instant, to have no friction, and to be personalized. And that's why AI is such a big driver, enabling dynamic payments and real-time credit. Customers don't have to wait for days for approval or for application of rewards or cashback. They expect decisions in seconds. So the expectations of the customer, that's the bar is rising, and it's not enough to embed finance. It has to feel natural. So it has to be that invisible thread. It has to feel personalized, has to feel trustworthy. They don't want generic payment options. They want solutions that match their behavior and feel tailored to them. And the companies and the banks that meet that standard will own that customer relationship.
Yeah, building with the customer, gaining the customer's trust, really working through the lens of the customer is what makes a fintech a winning embedded finance fintech, a winning embedded finance fintech.
Exactly. But it has to be invisible.
What are the biggest blockers preventing wider adoption of embedded finance today? And which pieces of the puzzle still need refinement before they can go truly mainstream?
So I would say two things. One is economics. Margins in payments and lending are so thin. So unless there's a clear return on investment for both the platform and the financial institution, adoption will stall. And the second is standardization. When I was building, every integration felt bespoke. So there were different APIs, different compliance interpretations. And unfortunately, that doesn't scale. Until we have common rails and better orchestration, embedded finance will stay concentrated amongst the bigger players rather than new entrants. And as someone that has founded a fintech startup, the key is speed to market. And so having fragmented integrations that all look like different languages, none of that is useful, unfortunately.
Do you have or can you expand on how you think compliance can be more, put together so that it can scale faster?
Good question. I feel like it is hard to create compliance rules or documentation that is one size fits all. But if there were better, how do I put this? If there was more standardized process into what a startup would need based on the product that they're building and the outcome that they're trying to achieve. If there was a better, I guess, guide to telling you, okay, these are the things that you need in place. Here is a compliance flow. Here is a decision flow where you need to bake in risk and fraud. This is how you build a decision flow. For example, I think when I was building, we didn't have any of those guides. We didn't know what kind of licensing we would need. It all came down to asking 100 people and taking the advice of 3 people.
Mhm.
So I think if there was, I guess, more, and I think this is where banks and card issuers, etc., any large player in the ecosystem, this is really where they can add value to smaller fintech startups, is having a process where almost like a checklist to say, this is what you need. here is a template. You can go and customize this template and then submit it when it comes time to trying to come up with a partnership agreement. So I think, it's hard to do a one size fits all, but I think you can create some custom templates. So at least give people a starting point.
Yeah, especially in this industry in fintech, because we're dealing with people's money, because we're dealing with retail money, right? The regulation is there, the compliance is there, and it's high level, and it is for a reason. But it makes it very difficult as you said, any kind of fintech startup to actually know, what do I need? There's no one source to go to figure that out. And a lot of times what happens is fintechs end up figuring out the hard way, right? Which is
Yeah.
either losing a partner or getting a big fine. And I think that's something that, possibly AI could help us with to make that faster, figure out how we can get there. And as you said, also the larger players in the ecosystem, if they do want to work with fintechs, especially startups, getting that sort of help at the beginning can be a huge benefit to building that partnership and making it very strong.
Yeah, absolutely. It's building trust with your potential partner as well. So if I went to a bank or a large institution to sign up to issue cards or something similar, if they helped me along that journey, they're the ones that I'm gonna give all my money to, it's two-way street there.
So for all the smaller fintechs out there, trying to build in this space and they're reaching out to bigger players and not hearing anything back, do you have any recommendation on how to go about that and how you were successful in doing that?
So one, I would design resilience in from day one. So we had backup options if a partner wobbled, and we could still go to market, find revenue streams, prove our value proposition, own our core IP, but then partner when it's a commodity. But also finding the right partner is someone that's going to understand innovation and want to support you in innovation. That would be my advice when it comes to partnerships. It's really who is listening to what you're trying to do and wanting to help you through navigating the regulatory process or finding new distribution channels, finding new revenue streams.
Absolutely. Like really owning that partnership instead of just being another vendor or a big player that doesn't really give you the time of day. So we talked about, keeping your resilience and assuming that a link will fail in your system. Can you dive deeper into that? How do you keep the resilience if one of the links fall?
I'd say so. I think I've mentioned this, but design it into your journey. So assume that a partner will wobble. So designing in resilience from day one. So making sure that you've approached multiple partners, not just one, have backup options, having enough money in the bank to make sure that you can afford partnering with a certain provider. That's important because often they'll say yes without realizing that you can only afford to pay them for a certain period of time. So that's, again, I feel like a lot of founders would go through that journey. And yeah, I think what is really important to note, I know this is about partnerships, but it's really important to make sure that you own your core value proposition. You shouldn't be relying on third-party suppliers to actually get your product to market. Yes, that if eventually that's what your product needs to be and needs to look like, but if you can own the customer relationship from the get-go, so saying, this is my core value proposition, this is our IP, we need a bank or a card issuer or I can't remember what the other terms are, but if you need third parties to go to market with speed and scale, amazing. Find the right partner, but own your core value proposition, own your customer relationship. Make sure you don't have to rely on the third party for those things.
So really focus on owning that UX, that anything that is interacting with that customer, and that should be the biggest focus. While if you
Yeah.
need the background, the back-end supplier or vendor, that is okay because it's all about getting, fast to market.
Yeah. And actually, that would improve your chances of signing the right partner because you can show, hey, there's a market for this. This is what you're not just saying, this is what we're trying to do, and we need your services to go to market. You can go to a partner and say, this is what we're already doing, and this is the demand that we have for our value proposition. If you work with us, you can help bring this alive, rather than having 100% reliance on a partner to make your product a reality. So if you can show partners you own this customer relationship, you're adding value, you're creating demand, that will make the partner want to work with you.
Yeah, when you're talking to those larger partners, sometimes it can feel like it's almost like you're pitching, right? You're pitching your product, like you're pitching that they're going to give you time to work with you, because on their end, it is a bit of a cost to work with a smaller player unless they really believe that you have that momentum and that'll keep
Exactly.
them
Yeah,
long term.
exactly. And that's where you should think of these partners as platforms, and rather than just suppliers, they're there to support you on your journey. And that should be a two-way street.
And so, talking about the way forward, what's the minimum viable embedded finance strategy for the next 12 months, in your opinion?
So I would say, from my experience, pick one use case that directly improves your product and go deep on that. When I was building, I was tempted to embed multiple features at once. And the best results came from when we focused on one single high impact use case tied to customer behavior to prove adoption, and then expand from there. So pilot tightly, measure the return on investment, and that comes from conversion, retention, margins, and then use that to earn the right to scale.
And when we're talking about, embedded finance strategy and adding these new products, how would you recommend doing it? Would it be to start like an MVP and just test, or do you want to, go all in with your partners?
Oh, definitely start with an MVP because I feel like any startup, any founder, any business will tell you that what you assume is your core product and what you assume you're going to be selling to customers will look very different from version one. By the time you get to version 7, it's going to look completely different. So as long as you have the customer relationship, you can identify what they want, what they need, and you can build to that. So start with an MVP, measure your return on investment, customer acquisition, unit economics, make sure you nail that down. And then you can start picking up different features. And that's where embedded finance providers will really come in handy, because we talked about that plug and play model and the modular offerings. If I go deep with one feature in my MVP and I really quickly want to add in another feature, that's where I'm going to pick the best partner and make sure that they can help me get that speed to market, because I've got this customer relationship now, which is the most important. It should be at the core of any business, and then go from there.
So, if my conversation with Trina today sparked any curiosity, we'd love to hear from you. Share your thoughts with us and join us next time as we continue to explore and witness the future of fintech and embedded finance, one episode at a time. Thank you.